Hi, and welcome to the Intentional Wealth Update from Morton Brown Family Wealth for the week of August 9th, 2021. I'm Dennis Morton here with Cody Demmel. Cody, how are you doing this morning?
Good, how are you?
Great. Today we're going to talk a little bit about some of the assumptions that go into financial planning. I mean, we talk about things like how much you're going to make and how much you're going to spend. But every time we put together a plan, there are certain assumptions that are out of our control. Things like how much we're going to earn on stocks in the future, how much we're going to earn on bonds, what the inflation rate is going to be. And man, we've seen a lot of changes in that over the last 12 months. We're going to talk about inflation this morning. We're going to talk about interest rates. We're going to talk about stock market expectations. Let's take a quick story about how expectations work. The higher the markets get, the lower your expectations should be. It's a paradox a little bit. If you're expecting something to be worth $10 in the future and it's currently worth $9, your expectations are here. If the price drops down to $5, your expectations go here because sometime in the future, we still expect it to get to 10. That's what's happening in the stock market right now. So we've hit all-time highs, 19, 20 times this year on the S&P 500. So, but Cody, expectations are running rampant. What the article from Jason Zweig, tell us about where investor expectations are for the stock market right now.
Yeah, so I thought this was a great article in the Wall Street Journal that went over a survey from 170 different U.S. investors about what their return expectations were for the rest of this year, but then also the 10 years moving forward. So for this year, they expected to get around 17% returns. And this is after inflation. But for the next 10 years, they expect their annual return to be 17.5% after inflation.
Okay, let's put a little perspective on that. How does that compare to, say, the last 90 years of stock market performance?
Yeah, so that's almost double the average return of the stocks over the past 100 years.
So we're not going to return X. We're going to return 2X per year over that time. I don't get concerned when the stock market hits all-time highs. It's when expectations start far outstripping things. Financial plans don't crash when markets decline or when interest rates rise. Financial plans run into trouble when expectations aren't managed properly. And if you plug in 17% returns into your financial plan and make that your norm, you're going to make some mistakes when reality hits. And Vanguard gave us a little bit of a dose of reality when they talked about what their forward-looking expectations are based on some historical norms. What do we find out there from Vanguard? I think you have the chart to pull up here, right?
So Vanguard just came out with their 10-year projections and this is their annual projections over the next 10 years. So as you said, they've brought in a lot of reality to, obviously the return we've had over the past 12 years has been really strong. And as you discussed earlier, when we've had such strong growth over the past 10 years, maybe it is time to think more neutral about the returns expectations going forward. And these return projections obviously bring that into reality.
Yeah, absolutely. I mean, you look at those 2.4, 2 to 4%, 2 to 4%, a little bit of a spike up in the global equities, 5 to 7% there. So again, there's value to be found. Investing globally and being diversified pays off. Look at that U.S. growth number. I mean, some of the high valuation growth stocks right now, negative expectations over the next 10 years. Now, that's not to say this comes true any more so than 17% per year comes true. But we often we call it a humility question, and we ask it of ourselves. And if someone were to come in and say, I think the market is going to return 17% per year, we would ask them this: what if you're right? What happens for your plan? What if you're wrong? What happens? And then, have you ever been wrong? Because if you're wrong and getting 17% and banking on that, and things turn out to be half that, which is the historical norm, that could create problems. Or if you're expecting too low and you invest too conservatively, you can miss out on the other side. So there's an art and a science to this, but managing expectations and making sure you have the flexibility to maneuver really matters.
Yep.
Today, though, Cody, we got data on inflation, which is another factor that's out of our control. We can't control interest rates, inflation, or stock market returns. But inflation's top of mind for a lot of people right now. What did we find out this week about CPI?
Yeah, so inflation's definitely been top of mind, especially at the large numbers we saw in June last month. So July's numbers just came out this morning, August 11th, and they were right in line with estimates. So July's total CPI, so consumer price index, jumped 5.4% from last year. The number that most of the investors were worried about was the core inflation rate, which is the CPI excluding energy and food prices. And that only jumped 0.3% from June of this year and only 4% from last year, which both were below the estimates, which was a good sign for people that were really concerned about inflation moving forward.
Right. I mean, it's a big number. It's going to catch a lot of attention. I mean, there's going to be a lot of, you're going to see this popping up a lot in conversation with, it hasn't been top of mind for decades for people. But if we think about the environment that we've invested in, that we've planned in, that we've lived in for the better part of 10 years, there are a few numbers that pop out to us: 2, 2, and 10. 2% inflation is where the Fed had a target for a long time. Never quite got there. Inflation was always less than 2 for the last decade. 2% never really got above 2% for very long on interest rates. So we had a low interest rate environment, low inflation environment, and 10%. We were getting 10% plus per year out of the stock market for the better part of 10 years. So what we would ask you to consider is, are those the conditions that we're going to continue to invest in? I think that the less than 2% on interest rates, that's probably going to be here for a little while. I mean, there's a lot of will on the Fed's part to keep things lower for longer. The 2% inflation, we don't know if this is transitory, if it lasts, but hey, it's definitely more than what it was. But then coming back to that 10% stock market returns, that's where we say, all right, be mindful of how much risk you're taking, because that regression to the mean can take a lot of forms, right?
Yeah, exactly. I think that's pretty much the main thing is getting back to the average over the past 100 years, which is close to 8%. I mean, we've had, I don't know exactly what the annual return is over the past 10, 12 years, but it's definitely double digits. So getting back closer to that 8% is where, I mean, that's pretty much where Vanguard's numbers are getting that 4% from.
Right. And we don't mean that this is not, Chicken Little or the sky is falling or anything like that. It's more of, know that volatility is a natural course of things. We talked about before, we're in that long period of very low volatility. We're going back to October, November of last year, since we had even a 5% correction. We're supposed to have more than that. And so I think some choppiness would be expected, but that's why we keep that balance in there. So if you're planning along at home, check in on your assumptions. What you're spending, what you're saving is what you're earning. And then there's all the other things out of your control that we say, what factors are we applying, and make sure that they're in line with what's reasonable and what's going to help your plan to be sustainable in the future. All right, well, thanks a lot for joining us this week. We hope everyone's summer rounds out really well. Look forward to catching up with you in the fall. We're going to be planning another quarterly market update at the end of the third quarter to keep everyone appraised of what's happening from a planning perspective. We expect some policy changes this year, and we'll stay on top of it on your behalf. So have a great rest of the week, and we'll catch up with you soon.